There are rare moments in financial history when the convergence of fear, uncertainty, and undervalued assets creates a genuine generational wealth opportunity. We are in one of those moments right now. This is not hyperbole. 2 years ago, we identified CrowdStrike and Arista networks before the broader market caught on. Bloom Energy was flagged just months ago. Palantir was on our radar years before it became a household name. These weren't lucky guesses. They were the product of rigorous, data-driven analysis. Today, I want to show you, with the same discipline, exactly how sophisticated investors are positioning themselves during this period of volatility and how you can do the same. Understanding the current environment. We are now roughly 4 to 5 weeks into the conflict with Iran. Diplomatic signals are contradictory, markets are rattled, and if you've spent any time on financial media lately, you've likely encountered no shortage of analysts insisting that this time, unlike every other time, everything is fundamentally different. It isn't. Let me show you why, using historical data rather than sentiment. What history consistently tells us. Every major geopolitical conflict, without exception, follows a recognizable pattern in equity markets. In the first 30 days following the onset of conflict, markets typically find a meaningful bottom. We predicted this on the very first day of the Iran conflict, and by approximately March 30th, the data confirmed it. The S&P 500 bottomed right on schedule. As of mid-April, we have already retraced back to pre-conflict highs, near 6,900 on the S&P 500. But here is the critical nuance. The recovery does not move in a straight line. The next 12 months will be characterized by significant volatility, drawdowns, corrections, and sharp recoveries. That volatility is not something to fear. For the disciplined investor, it is the mechanism through which wealth is created. The macro risk, and why it's overstated. The primary driver of current market anxiety is oil. Elevated energy prices generate fears of sustained inflation, which in turn raises the specter of recession, stagflation, and the kind of prolonged economic contraction last seen in the 1970s. That fear deserves to be addressed directly and dismantled. As the economist Milton Friedman articulated with precision, oil prices do not cause inflation. Inflation has one and only one origin: the rate at which money is created relative to economic output. Governments hold that lever, not oil markets. Furthermore, oil prices are inherently cyclical. At $100 per barrel or above, demand destruction sets in. Businesses and consumers simply cannot sustain activity at those price levels, and demand contracts accordingly. Sustained prices above that threshold are not economically viable. They correct. The long-term investor's advantage. So what should a rational, long-term investor do with this information? Let us look at the data rather than the headlines. Since 1932, the average bull market in U.S. equities has lasted nearly 5 years, delivering average returns of approximately 180%. Bear markets, by contrast, average roughly 18 months with peak-to-trough drawdowns of around 35%. The asymmetry is striking, and it is structural. In the past 20 years specifically, 16 of those years were bull markets. 2 extended bull runs delivered gains of 400% and 100% respectively. 3 bear markets occurred during that same period, and while their drawdowns, 49%, 57%, and 25%, were painful, they were also finite. The legendary fund manager Peter Lynch summarized this dynamic with characteristic clarity. Far more money has been lost by investors preparing for corrections than has ever been lost in the corrections themselves. The statistics reinforce this at every time horizon. Day traders face a success rate of roughly 54%. Swing traders improve that to approximately 75%. But investors who simply hold broad market positions for a full decade experience positive outcomes in 95% of all 10-year periods ever recorded. Every single 20-year period in U.S. market history has been positive. The current entry point is genuinely attractive. Here is something the volatility narrative obscures. The S&P 500 today is trading at essentially the same price level it occupied last November, around 6,900. However, the forward price-to-earnings ratio has compressed from 26 down to approximately 20. That compression matters enormously. Historical data shows that investors who enter the market at a forward PE of 26 can expect near-zero returns over the following decade. At a forward PE of 20, the historical average annual return over the subsequent 10 years is approximately 10%, precisely in line with the long-term average. In other words, the market has become materially more attractive for long-term investors without the index itself having declined meaningfully. That is a rare and meaningful setup. How to position yourself intelligently. None of this means you should deploy capital carelessly. The market could move substantially lower from here, and that possibility should be embraced rather than feared, because it would represent an even more compelling entry point. The approach that consistently outperforms is dollar cost averaging, deploying capital in measured, consistent increments over time, rather than committing everything at once. This ensures that if prices decline further, you retain the capacity to increase your position at more favorable levels. The investors who generate the most significant returns during volatile periods are those who arrive financially and psychologically prepared to act when others are paralyzed. If you are investing in broad market ETFs, instruments like those tracking the S&P 500, the index will rebalance itself over time, removing underperformers and incorporating new leaders. You do not need to manage it actively. If you are building a portfolio of individual equities, two qualities are non-negotiable: rigorous stock selection and the conviction to hold through significant drawdowns. Great companies purchased at reasonable valuations. Think Microsoft at $15 in 2009, now trading north of $300. Reward patient investors who do not panic at the inevitable volatility. You don't need a head start, you need a decision. Start investing early, diversify everything, build more than one income stream. Subscribe if you're serious about it, and I'll see you in the next one.